Alright guys, so again, just waiting to see a couple more people show up. Give it one more minute and I'm gonna get started. Anybody who's logged in, if you guys could type in I'm here on the chat, that'll be awesome. Appreciate it. Okay. Alright. Alright, so I'm gonna start like in a minute. Alright, so I'm gonna get started now. And we'll just, whoever shows up, shows up. And I feel like there'll be more people showing up though. Alright guys, let's get started. Alright guys, so I'm live. You guys should be able to see me. If you guys can see me, please type yes on the chat room. Just want to make sure, because I'm showing my desktop and I'm going to be showing you guys some websites, so it's important that you guys are able to see me so you guys could see the websites that I'm going to be showing. So can you guys see me? Alright, cool. Alright guys, well thank you very much, Martin. Yeah, I did my hair, I took a shower, so that's why I'm looking good. Thank you. Alright guys, let's get started. Okay, so today what I'm going to cover is principles on investing and retirement, and pretty much I'm going to go over what that means and all that shenanigan. You guys, when it comes to investing, of course, the stock market is the most important component to investing and saving your money. And there's various ways you could do it. You could take a percentage of your paycheck and put it in a retirement account like a 401k, or I believe a 401b if you work for the government. That is actually the best way, in my opinion, because it's automatically and it takes out every 2 weeks automatic without you knowing. And it's also invested in a long-term portfolio like an index fund. So that's something that I highly recommend. And also you save money in taxes. Keep in mind that every single dollar you put in a retirement account is not going to be taxed by the federal government or the state government. So you are actually keeping more of your money. And I know for a lot of you young folks, maybe right now you're not making a lot of money. Maybe you guys are making maybe $15 an hour or so. So the taxes don't really hurt you that much. But as you get older, you start making more money, maybe $40,000 a year, $50,000 a year, $60,000, $70,000 a year. The government is going to take 25%, or if not 30% of your paycheck, which is a huge amount of money if you think about it. That's a lot of money, So saving as much as you can, keeping as much as you can, is the best way to go, and put it in your retirement account is the way to go. So I'm going to show you guys a simple formula that I learned when I was in college. I took a math class in college, and my professor covered a section in finance and investing, and covered compounding interest. And the thing about compounding interest, a lot of people know about it, heard about it, but they don't really understand it and how powerful it is. And I was like 18 years old, when I found out about this compounding interest formula, and how you can make a lot of money, or actually how your investments could grow bigger and bigger over time, and it's like a snowball effect. And before you know it, 10 years, 20 years, then you got like 100, 200, 300, $400,000, $500,000 in your account, just by the simple fact of compounding interest. And I'm going to show you guys how that works, and I'm also going to show you guys what investments could give you that type of return. So simple compounding interest. Now, when I was 18 years old, I had a job at UPS loading trucks. I was making like $8.50 an hour part time. But again, when I found out about the um, about the compounding interest formula, I decided to put in 10% minimum of my paycheck towards a retirement account to save money in taxes and to try to grow my account. And I literally started when I was 18 years old. So I started with zero money. So if you look at the formula here, it says step one, initial investment. I mean, I'm starting with zero money, when I was 18. And I think I put in $100 a paycheck, so a month. Because it's asking for a month, I was putting in like maybe $200 a month. All right, and keep in mind that I'm 18 years old, and now I'm actually 30, so that's 12 years ago. So 12 years ago, okay, so I'm gonna put 12 years, and interest rates. Again, I invested my money in the stock market. On average, over long periods of time, the stock market earns around 10% a year, if not 12, but an average is around 10%. And okay, actually, I'm gonna put. There you go. We've changed it a little bit. Now, you guys should know. I'm gonna answer questions after I'm done with the webinar. When I'm done with covering the things that I'm gonna cover, but I will answer all your questions. I will go over your questions that you put on the chat. So if anybody has questions, put them on the chat. Just write them down there. Any question you guys have, put them in the chat. And when the webinar is over, I'm gonna go over all the questions and answer any questions. And if you guys have any more questions, I'll answer more questions. So I'm just giving you guys an example of how powerful the compounding interest formula is, so you guys understand that this is a must, especially if you're young. All right, so again, I started with zero money because I was 18 years old, first job. Again, put 10% of my paycheck into a retirement account, 401k, UPS. Now I'm 30 years old. So that's 12 years ago, and I was earning around 10% because on average the stock market gives you a 10%. So that's annually 10%. And now this is these 2%. This two is kind of like in case the stock market averages more than 2% a year. So now let's calculate that and see how that looks. All right. So let's look at the numbers. Okay, 18 years old, started with zero money, and just put $200 a month, earning 10% a year return. If you guys could see, over time, this thing just went exponentially. And the reason why is because when you put in $200, that $200 earns interest. And then you earn interest upon interest. Because the stock market gives you dividends. So the stock market, I believe, gives you like 2 or 3% dividends every single year. And that dividends is reinvested in the stock market every single year. And it compounds. So I started with $0 12 years ago. And it says that I should be having around $50,000 in my account. Which is actually about right. So I do have around $50,000 in my retirement account. So it's real. This thing is real. This is not a lie. This is real stuff. And actually keep in mind that I didn't work for like 2 years when I was in college. Actually 3 years. I didn't work. Well, I did work actually, but I was like part-time and I didn't put money into my retirement account. And that's $50,000 in 12 years. So I have around there. Not exactly, I have around there, actually a little bit more. But because I actually ended up putting more when I started working at Keller Graduate School of Management. So just simply by me allocating 10% of my pay into a retirement account, 12 years later, I have over $50,000 in my retirement account. Simple as that. I didn't do anything special. I didn't. I guess, trade it. Again, at that time, I wasn't trading. I was just. This is my retirement account. This is not my trading account. I have a retirement account and I have a separate account just for trading. So keep that in mind, guys. Again, that's the reason why I created the video, the difference between investing and trading, because there are differences. Investing and trading is different. This is just investments. This is long-term compounding interest, low risk. I'm looking to make money on time. And that's pretty much around how much I had in my retirement account. Now, this is just my retirement account. And it's crazy. Some people think like, wow, with $0, you just put in $200 a month, 12 years later, earning at least 10%, you have around 50,000. Yes, I do. And I actually have more. But I didn't do anything special. Just so you guys know. And I want you guys to understand that the most important thing about investing in the long term is time. Time. And I'm going to show you guys why. Because the longer your money is invested in the stock market, the more money you're going to earn on interest, compounded over a year. You're going to be earning interest on interest, interest on interest every single year. So I want you guys to understand that the most important thing in the formula is time. Now, I am 30 years old and I plan to retire when I am 65, I guess, So 65 minus 30 is 35 years. So that's 35 years more. So 35 plus 12, that's 47. So I'm going to put that 47 years I'm going to be working. And actually, I'm just putting $200. I'm going to keep it simple. $200 a month. Because keep in mind that when you start working, you're going to be earning more money. So if you think about it, let's say you make $5,000 a year. $50,000 a year. 10% of that is $5,000 a year. So you divide that by 12. You put in around $400 a month. So if you're making around $50,000 a year and you put 10% of your income to your retirement account, that's around $400 a month you're putting. I'm just putting a simple example of just $200, which anybody could do. Even $100 you could do. And we all know that. And you guys know that you guys could save $100 a month. Everybody knows that. And actually, you could probably do more. Instead of buying those nice pair of Nike shoes, hey, put the money in the stock market. Nike shoes gonna lower, unless you buy some like rare Nike shoes, and maybe it'll go up in price, but not like the stock market. Let's put it that way. All right, so I'm giving you an example: $200 for 47 years, 10% annually return. Boom. So by the time I'm 65, I should have around $2 million. And if I were to earn around 12% a year, which it could happen, the market does average around 10 to 12%, I could have around $3.6 million by the time I'm 65. So think about that, guys. It's a very important concept, because what this means, if you guys could see this means that anybody, and I mean anybody, can become a multimillionaire if you make the right decisions when you're young. Anybody. Doesn't matter. Because anybody could put in $100 a month into their savings, into a retirement account, into an investment account, index fund. Anybody could do it. And this is something that I've been encouraging Lizette. And she still remembers when I used to tell her that when we first graduated college, and I encouraged her, babe, put 10% into your retirement account. And she listened to me. So now she's doing pretty good, and she's pretty happy. She's pretty happy where she's at right now. And it's pretty nice, guys. And sometimes it's even hard to believe that, like, how could you put in only $200 a month and in 47 years, 40 years, all of a sudden you got $3.6 million. Again, it's compounding interest upon interest over time. The most important component of this is time. That's the most important thing. You got to start early. The problem a lot of the times is with a lot of older people, and there's a problem right now with retirement with a lot of older people did not put money into their savings. Maybe they saved money, but did not invest it, and that's the problem. Because anybody could say, yeah, you could save $200, for 20 years, but if you don't invest it, you're not going to earn interest upon interest upon interest, especially the bank where they only pay you like not even 1% a year. They pay you like 0.01%. There's a lot of people, I'm sure you probably guys know, your parents maybe have like $20,000, $30,000, $40,000 in their savings for retirement. But if they would have invested in the stock market $200 at a time a month, they probably already had right now, they probably already had like $1 million or $500,000 in their account. So I want you guys to understand that the power of compounding interest, because it's real. I've experienced it in my life. Lizette experienced it in life. You have the accounts to prove it. The money is there. Actually, that's one of the main reasons why I quit my job 2 years ago, because I have that as a safety net to do what I do. So it's so important to start early. Now, I'm going to put an example. I'm going to change it up to 40 years, and I'm going to put $400 a month, because actually I'm going to put it 30 years. Let's say that you go to college, you graduate when you're 25, and you start making $50,000, by your 27 or whatever. And then so you put 10% of your paycheck to a tax deductible retirement account, and you put $400 a month. Let's just put 30 years. You're in 10%. Calculate that, and let's see where you at. So if you put just 30 years, $400. You know what I mean? $400. Now, keep in mind that I took out 17 years off the picture. See? I'm putting way more money. I'm putting $400, and but I'm only have 30 years before I retire. Actually, I'm only gonna have by the time I retire, let's say $1.1 million. And again, like I said, the most important thing is time. So that's an example of how starting early is so important. Even if you start small with $100, $200, it's a lot easier to put $200 a month than it is $400. But just you guys starting early is the most important thing. So let's say that you start early and you start making $50,000 a year, and you put in $5,000 a year, and you work for 40 years until you retire. Let's see how much you will have. So by the time you're 65, you'll have around $2 million and $3.5 million. So the crazy thing is that those extra years add an insane amount of money. So let's say I'm going to put 50 years. I'm going to put 10 more years. Let's see how that makes a difference. If you put 10 more years, you have $10 million if you earn 12% a year. Actually, $5 million if you earn 10% a year. $10 million if you 12% a year. I know that's crazy. I know it sounds crazy, because when I first learned about this formula in math class in college, I was like, holy mackerel, I was mind blown. But it's true. Math does not lie. And I've already experienced it in my life, and I know Lizette has too, and I know my parents have been experiencing it. I know they started investing late, but they have only been investing for the last 4 or 5 years, putting in $200 a month, and they're already doing pretty solid. So think about this, guys. So if you put in $400 a month, 50 years, you'll have around $10 million if you earn 12% a year return. $10 million. So think about that. 65 years old, have $10 million in the bank. You pretty much could live on interest. You know, you could have a very, very awesome lifestyle. And the reason why there's a huge, huge wealth inequality in the United States, a lot of it really is because people don't put money into their retirement account. And again, it doesn't have to be a lot. The most important thing, you have to start early. You have to start early. So I want you guys to understand that, because that's the most important thing. Now, what I'm going to show you guys now is show you what gives you, 10% or more a year. What investments give you that. And it's very simple, actually. You can just invest in an index fund, which is diversified, so you don't have to worry about it crashing or losing all your money. It's diversified, so it's pretty safe. So just keep that in mind. Now, if you guys want to play around with this calculator, welcome you guys to go to investor.gov. This is a government website by the SEC, Securities and Exchange Commission. So it's a government website. So I highly recommend you guys do this. So if you guys want to learn more about investing, how to do your research, etc., it's all here. It's all there for you guys to look at. So what I'm going to do now, I'm going to go to another website and show you guys, what investments give you 10% or more a year. The easiest one is just to invest in the general stock market. Spiders. You could invest in the ETF, SPY. Most retirement accounts at your work will have like a retirement index fund or mutual fund that's invested in the S&P 500. So every one of you guys, I highly, highly recommend to look into your retirement accounts and see where your money's invested. I highly recommend make sure that it's invested in something in the S&P 500, because this is the most efficient investment vehicle out there. Over time is proven to work. We're talking about the last 100 years plus. So this is the best one to put your money in, the S&P 500. Now let's look at the performance. All right, so where's the performance? Oh, here it is. Here it is, performance. All right, so just so you guys know, so far, year to date, starting in January through November, the S&P 500 has already earned 16.68%. Think about that, guys. It's earned more than 10%. A year since Donald Trump got elected is actually earned 23%. And the reason why the stock market had a huge increase, a huge jump, was because a big proponent of Donald Trump policy is to lower taxes. Why is lowering taxes so important? It's because they're going to lower taxes to corporations. And when you lower taxes to corporations, they can use that money to reinvest it to grow their companies. So it actually benefits stocks, benefits companies as a whole, and benefits the whole economy as a whole. So keep that in mind. That's the reason why the stock market, since he got elected, has been up like 23%. Now, 10-year return, if you look at the 10-year, it's been averaging around 7.44%. Now, the reason why it's less than 10% is because of 2008, when there was a huge recession. And I'm going to show you actually the graph. So right here, I have the graph. This is the S&P 500. Now, this is the ETF, which you could actually invest in with a brokerage. Simple strategy, just buy the S&P, just buy SPY. ETF, it's simple. Buy and hold. You don't have to do anything special. You don't have to buy and sell like a trader. I'm a trader. It's different. It's a different strategy. Remember, there's a difference between trading and investing. As an investor, you just buy and hold. You're looking at the long term, 30, 40, 50 years. You know what I mean? Your goal is to make money on interest upon interest upon interest. You're not making money in speculation with trading, which is something I do. That's separate. All right, so I'm going to show you guys last 10 years. All right, so let's take a look at this. All right, here we go. I'm going to put it monthly. There you go. Okay. So this is the stock market in the last 10 years. As you guys can see, here's 2007. This is where the market crashed. It didn't really crash. It just lost like 30% of its value. But guess what? It rebounded. Now, I want to show you guys a bigger time frame. Let me see how big can I go. Oh, there you go. I'm going to go max available. Let's see how big this could go. All right. Okay. Now, it's very, very important for you guys to understand this, that how the economy works, it works through cycles. And just keep in mind that there's a lot of reasons why the stock market keeps going up. And the number one reason why it keeps going up is because of inflation and the Federal Reserve. All right? So you guys remember the tech bubble, right? This is the tech bubble, the 90s. I'm looking at right here, 1993 through 2000. 1983 to 2000, literally the stock market doubled. So from 40 to 80, actually it went 3 times. It tripled, through like over 120, actually 140, more than triple. So, and that's since 1993, so like in less than a 10-year period. But of course, then you had the bust, the tech bust, if you guys remember, in the 2000s, where the economy, there was a big recession. It did drop like over 30%, 40% in 3 years. But guess what? It rebounded. Why did it rebound? A lot of people ask. It's simple. The Federal Reserve. The Federal Reserve's job is to stimulate the economy, to have lower unemployment, one, and to keep inflation at 2%. So when employment is high, which happens during a recession, guess what the Federal Reserve does? They stimulate the economy. They do what's called quantitative easing. They literally buy stocks and bonds, mostly bonds, which ends up in a stock market anyways, and that pushes the stock market forward. And that's what happened after 2000. And literally, the funny thing is, it happened when George W. Bush went into office, and literally George W. Bush did something similar that Donald Trump's going to do, which they did is lower the taxes. And then it stimulated the economy, and boom, it's back to its highs. And then, of course, this was a deeper pullback. This was the 2008 house bubble crash. And the stock market, I think it lost more than 30%, might have lost 40%, but guess what? The Federal Reserve did the same thing. Once the economy started crashing, and following the recession, unemployment started going up, et cetera, people were losing jobs. The Federal Reserve stepped in again, like they always do. What is their job to do? To stimulate the economy again. They quantitative easing, they bought bonds, stocks, and guess what? The economy started pulling up again, et cetera. So we've been like in a bull market, a serious bull market since 2008, since the recession, stock market wise, and it just keeps going. So the reason why I show you guys this is because I want you guys to understand that this is a long-term game. There's going to be bull markets, there's going to be recessions. A recession was an AKA bear market. Is normal. It's a cycle. It's absolutely normal. There was one in the 80s, just that there's not enough time space over here to show it. But there was another in the 80s. There was in the 50s. It happens like almost every 10 years, if not more. It's normal. It's part of the economy. But as an investor, the best times to invest is actually during a bear market. Believe it or not, this is the best time to invest because you're getting a good price. You're getting a bargain for your investments. And again, if you're buying in a monthly basis, it doesn't matter if the stock market goes up and down because you're gonna do what's called dollar cost averaging. So at the end of the day, you're gonna average out. You know, you buy high, then it goes down. You buy low, then it goes up. Excuse me, you buy high, and at the end of the day, it's gonna average out because you're buying every single month. You're not coming in with $1 million and buying it as a whole. You're just buying it $200, $400 at a time. So it doesn't matter if the stock market goes up and down because you're looking at the long run, 10, 20, 30, 40 years. Actually, you should be looking at 30, 40 years or more. All right, so that's what I wanted to show you guys. Now, there's another thing that I want to show you guys. So now, another one another index that I also recommend is Nasdaq, which is the big techs. You know, like companies like Facebook, Amazon, Apple, Tesla, Google, Netflix. They're all part of the Nasdaq. And the Nasdaq this year alone, actually years to date, since January to November, is actually close up to almost 30%. Almost 30%, which is insane. And this one's actually been doing the last 10 years. It actually did a lot better than the S&P. Was 11.75% in the last 10 years been averaging. So the Nasdaq is actually not a bad place to put your money, especially now that we live in we live in an interesting economy now where majority of the businesses, the money is going to technology companies. So the Nasdaq has been killing it, man. Even during the recession, the last 10 years, it's still averaged above 10% a year. That's pretty amazing. That is very amazing. And this year, the stock market and the Nasdaq have been doing good. So my portfolio, my investments have been doing really good. So I'm very happy. So I want you guys to understand that, you know, that's very, very important, guys, because there are investment vehicles out there. And it's simple. Again, all you have to do is buy and hold. Buy and hold. There are mutual funds that will do it automatically for you, you know. And again, the best one literally really is companies 401k that I forgot to mention is that a lot of companies match like 3% or 4% or even 5%. That is free money. So if you think about it, they match 4%. That is insane. That's a huge advantage for your portfolio over time. You should absolutely be taking advantage of that money. You know, they're matching 3-4%. You should absolutely, there's no reason why you shouldn't be at least matching what your company's offering, which I think is they match up to 4% on average. There's some that match 6%, which is amazing. But hey, anything, you have to take it. So that's very, very, very important. Now I'm going to show you guys another. If you guys are looking for more than like 30% a year return, there's others. You guys can invest in individual stocks. Now that's individual stocks a little bit more tricky. So that does require a lot more diligence and a little bit more research. But again, for the average person, index is the best way to go. You don't have to worry about anything. You don't have to worry about the market being up or down. It doesn't matter. You're looking at the long term. You're buying $200 a month, $400 a month, etc. And again, the best way to do it really is your 401k, your retirement portfolio. You got to make sure that you are putting money every single month into that because that's going to grow over time. Now, the more the merrier. You know, if you could, my recommendation is to put at least 10% into your retirement account. Again, because the younger you do it, the better you're going to be off. And trust me, you know, if you're 25 years old and you're putting 10% of your money into your retirement, by the time you're 35, you're going to be a very happy camper. I tell you that right now. And I experienced that in my life. But I started when I was 18. So, hey, that's why I'm self-employed. You know, a lot of it has to do because I started early, and I use that. I have that as like a hedge, like a I guess you could say like a rainy day fund that I could in case. But I'm not gonna take it out. You know, I could, you know. But I have that as in the back of my mind. I have this. You know, I'm good. You know what I mean? I don't have to worry about a lot of stuff now. You know, so it's so important, guys, to do that. It's so important, guys, and you guys will benefit in many ways by doing and starting early. So absolutely, that's the most important thing to do. But I'm gonna show you guys some other companies like Apple. You know, who doesn't have an iPhone, man? I mean, Apple has been killing it, man. Let's look at Apple. Hold on, let me see. Where's Apple? Where is their performance chart? All right. For whatever reason, it doesn't give me their performance. Okay. Year to date. Let me look at historical data. Yeah, for whatever reason, it doesn't give me the percentages for Apple, which is kind of lame because Apple's been killing it. Apple is one of those stocks that I think if you 20 years ago, I think if you had $1,000 of Apple right now, that thing would be worth like almost $1 million, something crazy like that. Let me just put it here. Let's see how that looks. Okay, so this is Apple. Let me just see how the chart looks of Apple. Put 20 years. Yeah. Dude, look at Apple, man. Literally Apple, like 29. Look at Apple. And look at all the dividends. These are the dividends you get from Apple that you can reinvest over time, over years. But just look at this. Insane, man. There's a lot of people who just invested like $1,000 20 years ago, and now they're like millionaires or close to millionaires. Insane. Now, for whatever reason, again, it doesn't give me the performances annual base. I don't know why, but that's okay. Now, and keep in mind that this money, the best way to have this money is your retirement because, again, you're going to save money in taxes, so you're going to keep more of your money, and it also kind of gives you the don't take it out of your retirement because keep in mind that if you do take money out of your retirement, you're going to get a tax penalty of 10%. So remember that. There is a 10% penalty on taking out money in retirement. So there is that kind of like if you put money in a retirement account, it kind of gives you that, I guess, you know, knowing that you're going to get a penalty if you take it out, it kind of makes you not take it out or incentive not to take it out, I guess you could say. So that's a great one. Now you could also, besides a retirement account, you could also open a separate account, what's called a Roth IRA, or individual account, and also invest money in the stock market for other purposes. Maybe to save money on a down payment on a house. Maybe to save money for whatever, a trip, which you could do. You could also do that. Or maybe just to save money, you know what I mean? And that money is already since it's already taxed out of your pocket, you could, you know, take it out any time and not have to worry about any penalties. You will have to pay capital gains tax on that, but you don't have to worry about, you know, any penalties because you already pay taxes on the money. So you could also open an account for that. So just wanted to say that. But I believe that's pretty much all I want to cover. Is there anything else I want to cover? No, I think that's pretty much it. Now I wanted to see if actually Morningstar. Let me see if Morningstar can give me that. Yeah, Morningstar. I think Morningstar does give me the performances of these stocks. Let me see if it does. All right, so let's see if it does give the performances. No, oh, here it does. Here it is. Here it is. Performances right here. Oh, this is really cool. They even give you a $10,000, performance thing. Okay. Oh, where's the percentages? I want to see the percentages. It doesn't give you the percentages. Let me see, expand view. Okay, so this thing, it doesn't give you the percentages, which I want to see the percentage. Oh, okay, here it is. Here it is. Here it is. Here it is. Total percentage right here. Now, this is Apple. So year to date, Apple is up 53%. Year to date. So that is insane. That is awesome. In 1 year, Apple's up 60%. 3-year period, Apple's been up 18%. 5-year period, 18%. 10-year period, 22%. 15-year period, 40%. It's insane, right? So there are those companies out there that give you nice gains. Apple happens to be the best one, in my opinion. Again, when it comes to investment, of course, you have to do your own research. But Morningstar, actually, if you go to morningstar.com, that's a good website to do your research. But just look at that. 15-year average return on Apple has been 40% a year. That's insane. So one of the things that I want to mention when it comes down to getting above average returns, above the market returns, you got to look at market leaders. Who are the what are the stocks that are the market leaders, are leading the market? Which are the stocks that are leading the whole market, general market as a whole? And I don't know if you guys heard about this, but they're called the FANGs. Now, the reason why they're FANGs is because of the acronyms. F versus Facebook. Let's see Facebook. Actually, just look at pretty quick code of Facebook. Let's see how they've been doing. Facebook. And keep in mind that Facebook is not even that old. Facebook went public in 2011, so there's a lot of room for growth, I think, in my opinion. Facebook is like 5 years old, no more than 5 years old. Look at that. 5-year average return on Facebook has been 56%. That is insane. All right, so let's look at something else. So Facebook, and I already showed you guys Apple. I'm going to show you Amazon. Amazon is another good one right now. So right now, the market leaders, again, are the FANGs. Are Facebook, Amazon, Apple, Netflix, and Google. And then there's Tesla too, but it's mostly those that I mentioned. But look at Amazon. 15-year return average 31%. It's insane. So in the last 15 years, Amazon has been averaging around 31% return. This year alone, year to date, it's 50%. Year alone since November, last year is 46%. 3-year return, 55%. That's insane. Okay, so that's Amazon. I already showed you guys Apple. Let's look at Netflix. Let's look at Netflix. All right, so Netflix, last 15 years, been averaging 46%. This year alone, 1 year, this year actually from January to November, this year is actually up 56%. In 1 year, it's 58%. That's insane. That is insane, man. Talk about making money in the stock market, man. Just buy the FANGs. Well, again, I'm not a financial advisor. Talk to one, but this is pretty awesome. Now let's look at Google. Google. All right, Google. All right, Google last 10 years, actually Google last 10 years been averaging only like 9%. Not too bad, I guess. But year to date, it's up 32%. In 1 year, since the last year, November, is up 30%. So not bad. It's literally following the general market, the Nasdaq. So it's not bad. But definitely not as good as Facebook, Amazon, Apple, and Netflix. They've been killing it. Now let's look at Tesla. Tesla's another one that is kind of considered a market leader as well. Sorry, guys. Okay. Last 5 years, yeah, Tesla just went. I think it's no more than 5 years since they went public. So last 58%, 5 year average 5 year your return has been averaging 58% a year. That's pretty good. That's pretty amazing. And again, my personal belief, I love Tesla. It's the future. I believe in the company. So I do have money invested. Actually, I do have money invested in Tesla, Apple, Netflix, Google, etc. Whatever. Money is invested in those companies. Now, the reason why sometimes, besides investing in index funds like, S&P 500 or the Nasdaq, it's also nice to kind of put money in market leaders because they could kind of give you that alpha, the additional return on your portfolio that could really give you that extra push on your portfolio long term. So it is also important to kind of look for those market leaders to kind of give it an extra push on your portfolio to grow in the next 20, 30, 40, 50 years. And this is the reason why. So I'm going to go back to the compounding website and show you guys why that is important. All right, so let's go to compounding interest calculator. All right, so let's say that 50% of portfolio was on the Nasdaq, S&P 500, and the other 50% or 40% was on market leaders like Google, like Facebook, Amazon, Apple, Google, Tesla, Netflix. All right, so let's say, again, I'm gonna go back to zero. I'm gonna put $400 again because you're making $50,000 a year, whatever. You should put at least $400 a month, and I'm gonna put 40 years. Let's put it 45. 40 years. 40 years, I think, is the average. And let's say that instead of making 10% a year, but because you not only did you invest it on general market, but you also invested on the market leaders, like I mentioned, the FANGs, Facebook, Amazon, Apple, Netflix, and Google, and maybe Tesla. Let's say that you average around 20% a year. Now, let's see how your portfolio is going to look. Ooh, baby, look at that. So if you average 20% a year, by the time you're 65, your portfolio should be around $29 million. Insane, right? $29 million. I know some of you guys don't believe me, man. You guys are probably looking at me like, this guy's crazy, man. This dude doesn't even know what he's talking about, man. This guy's lying or something. Guys, math does not lie, all right? There's a reason why Warren Buffett is a billionaire, all right? That guy's worth like, 60 billion? There's a reason why there's a lot of multi-millionaires, especially when they're older, because they started early. They started investing early. They started investing early in stock market or real estate or whatever. But again, the stock market is the more passive one, because real estate, you have to kind of, it's almost like you have a part-time job, because you have to maintenance the properties. But the stock market, just buy and hold, buy and hold, buy and hold. That's it. That's all you have to do. You don't have to worry about anything. Your time can be focused on pursuing your passions. If you want to become a doctor, if you want to become a lawyer, you can focus on your passions and then invest 10% of your earnings every single year into the stock market for the next 10, 20, 30, 40 years, and boom. There's no reason why you're going to not be able to retire rich. And the worst thing you could be, if you're old and poor, man, that's the worst thing that could happen to you, man. That's all I'm going to say, man. At least if you're old, at least be rich, Yeah, that's my philosophy, man. Hey, if I'm going to be old, man, at least I'm going to be a rich old person, But let's look at it. Let's look at it in 20 years. Let's put 10 years. 10 years. If you earn 20%. If you earn 20% in 10 years, putting only $400 a month, you're going to have around $124,000 in your account. Just 10 years. So if you're 25 now, by the time you're 35, you have around 124,000. Let's put 20 years. 20 years. So you're 25. Let's say 25 now. You're 45. So 20 years old, you're gonna be 45 years old. You're gonna have around $896,000 in your account. So close to $1 million by the time you're 45. Let's put another 10 years by the time you're 55. So in 30 years, you'll have around $5.6 million by the time you're 55. So again, money doesn't lie. I mean, let's put it this way. Math does not lie. And one of the hardest things about investing is being consistent and being true with your investments and holding tight when everybody's scared. Because a lot of the reason why there's bear markets and there's a huge sell-offs in the markets because people get scared and they sell off their portfolios. It's not what you're supposed to do. Warren Buffett actually said once that be fearful when others are greedy, and be greedy when others are fearful. Because when everybody's afraid, everybody's selling, the whole stock market crashes, like I showed you guys right here. Everybody's freaking out, like, oh my God, there's a recession. Oh, I'm losing all my money. Everybody's freaking out, taking the money out of the stock market. Is the best time to buy. Did buys right here. Warren Buffett's bought right here. He went nuts. You know, he went nuts, and that's why he's a billionaire. You know, because this is when he buys. When everybody's scared, freaking out, boom, he gets a discount on his investments. You know, he buys right here, man. That's when he buys. So when everybody's scared, freaking out, he's buying. He's the one buying. See right here, he probably bought like maybe 8 million shares, or I mean like probably like $10 billion worth of stocks right here. You know, so you know what I mean. Again, when there are recessions, economic cycle, the Federal Reserve will always step in. That's their job. Their job is to stimulate the economy when it slows down, and when it heats up, their job is to slow it down so inflation does not go to over 2%, because that happens too. You know, when prices go up. So keep in mind that Federal Reserve is there to stimulate the economy. So that's the reason why you shouldn't be afraid. If anything, you should be ready to pounce the market when there's a recession. You know, or if not, it's actually just better, like I said, not even to worry about that. Just continuously put in the $200, $400 a month every single month. You know, again, doesn't matter the market's up or down. There's a recession, no recession. Again, you're looking at 20, 30, 40 years. From now, it does not matter. You got to be consistent. Putting money into the stock market. Consistent. From 20, 40 years from now, you're going to be a happy camper. All right, guys. So that's pretty much it. That's all I wanted to mention. Again, for those of you guys, I think Martin, I think your company does not offer a 401k. Again, you could open up your own retirement account. You know, Fidelity is a great brokerage that I recommend you to look at. They even have offices. Fidelity has offices, just like banks. They have offices where you could actually go in to their office, talk to a representative, and open up a retirement account. What's called a IRA, or a IRA will be the best one, because again, any money that you put there is going to be tax deductible. All right. One other thing that I want to mention, for those who are parents, I know Martin just had a baby girl, Luna. Congratulations. You can even open up a college fund. It's also tax deductible. So think about it. Your daughter was just born this year, so she's not even a year born. So when she goes to college, she's going to be 18 years old. So if you start small, put in $50 a month for the next 18 years. Let me just do that really quick. This is for Luna, guys. All right. For her college fund. Let's put it this way. All right. Compounding interest calculator. This is for Luna. All right, so let's say Martin, my boy Martin, decides, you know what? I want to save money for my daughter Luna. She was just born. I'm gonna give $50 a month, just $50. Put in the stock market for 18 years. So by the time she graduates high school, she's gonna be 18. Again, you don't have to do anything special. Put it in the general stock market, S&P 500. Again, it's gonna average around 10% a year. Calculate that. Boom. By the time she's 18, just $50, you should have around close to $27,000, close to $30,000. Hey, $30,000 is $30,000, man. I mean, that can at least pay for like 1 year. Well, it depends where she goes, you know. If she goes to a private school like Loyola, maybe it's like 1 year of school. If not, probably less, because by the time it's going to be even more expensive. But hey, this could definitely help her out at least, you know what I mean? It helps, you know? Definitely, you know, if you take her to community college, probably she's going to get more bang for her buck, but hey, it helps, you know? So just keep that in mind. Just $50, that's it. $50. Nothing special, just $50. That's all you have to do. All right, guys, so that's pretty much it. I'm going to answer some of your questions now and let's see what the questions are. All right, see what the questions are. Any questions? Let me see. Let me see what's going on here. Any questions, guys? Okay, now regarding the 401k, again, companies, if you work for a company that offers a 401k, definitely contribute to it. And again, most companies will match at least 4%. I think that's the minimum. But some do 6%. Some even do more. But keep in mind, take advantage of that match. And again, my recommendation is every single dollar you make in your lifetime, invest 10% of your money to your retirement. Just 10%. 10%, that's all you need. If you invest 10%, you retire, you're going to be fine. Like I showed you guys. Now, Christian just told me, is there a website to find old 401ks from past jobs? So if you had past jobs, well, first of all, if you had a past job, if you never enrolled to a 401k, then you don't have a 401k in your other job. So you would know if you invested in a 401k. Now, if you did put money in your 401k from past job, you need to contact your old job and contact their human resource department and tell them to give you the information for your old 401k, see where it's at, where they have the money, where is it invested. Now, this is something that's very common. A lot of people switch jobs. That's very common. You know, people work 2 years one job, 2 years the next job, 3 years. That's normal. That's actually very normal now. One thing, when that happens, you have to roll over your money. So let's say that you work at a company for 2 years, you got 10 G's. Roll over that money to a Fidelity account. That's my recommendation. Fidelity is the best way to go. Open up what's called a rollover IRA in a Fidelity account. Here it is. You know, you could go. You know, you could just go to the website and open it online, or you could go to they have their own offices. But see here, you know, open account. Click on open account, and then here, open up a rollover IRA. So if you have money from other retirement accounts and other companies, roll over that money to your own rollover IRA so you don't get taxed. Now, because if you take out your money from that retirement account and they give it to you, you're going to get taxed. All right? Remember that. You're going to get 10% penalty tax. Don't do that. Roll over that money to a rollover IRA. That's the way to do it. So you're not going to get taxed. And then once you have it in a rollover IRA, my recommendation is to look at the index, spiders. Buy the ETF, spiders or Apple, the FANGs or whatever, but spiders. But you could even do better. You know, you could talk to Fidelity has a lot of representatives for free. That if you open an account for free, they could give you free financial advice. Now these are licensed financial advisors. They could give you like free advice of where to invest your money. They can even recommend you mutual funds. They can even do what's called the automatic system, where you put automatic into your retirement account. But if you work at another company, you have a retirement account in another company, then of course you don't want to take out of your regular money. But just have that money invested there. So over time, if you work at 10 jobs in the next 10 years or the next 20 years, you have 10 different jobs. All them retirement accounts, you roll it over to your Fidelity account, so it grows, and then you have it invested in a mutual fund or an index like S&P 500 or the Nasdaq, et cetera, and it'll grow. So that's the way to go. Now let's see where else is there. Oh yeah, Robinhood. This app called Robinhood. Yes, I've heard of Robinhood. Now, Robinhood, the thing about Robinhood, yeah, it's commission free, but this is the strategy. This is what Robinhood is doing. Robinhood reminds me of a company that I actually used to have a brokerage with called Zecco. Pretty much their goal is to build their accounts, have as many people open accounts with them so they can sell off their company to a bigger brokerage. And it's exactly what Zecco did. Zecco was also a commission-free broker. And by the way, their fills were horrible. Horrible fills. They were horrible. And so their goal of Robinhood is literally just to grow their size. Get as many people to open up Robinhood accounts so they could be valued like maybe kind of like a social media. The reason why Facebook is worth so much money is because there's so many users. So they want to increase your user base, and maybe a big brokerage like TD Ameritrade or Trade King, looks at them like, hey, we want your users. We're gonna buy you up. We're gonna buy you $1 billion, $2 billion. That's their strategy. That's Robinhood's strategy. That's the reason why they're not, charging any commission. So I do not recommend Robinhood, even though they don't charge you for commission. Keep in mind that if you invest your money on like even Fidelity, their commissions are very small. I think it's $4.95 per trade, per investment. That's very small, and it doesn't matter the size. You could invest $1 million, and they will charge you like $4.95. I think. I mean, maybe there might be a limit, but I think $100,000, you could invest $100,000, and they'll only charge you $4.95 commission. So again, because you're investing, the commission goes down. Now, there's another question. Is there a way to set up automatic withdrawal? Yes, there is. In Fidelity, you could set up an automatic withdrawal where they take money out of your checking every single month, once a month. You could set it up Fidelity. Now, again, I recommend you go to visit a Fidelity office, and they could set it up for you. They could be a representative setting it up for you. And they can even recommend a mutual fund where they have no commissions, because Fidelity actually has some mutual funds, index funds. They have no commissions because they're a mutual fund from Fidelity. So you don't have to worry about commissions. So every month you invest $200, you're not gonna get charged commission for investing those $200. All right, so let's see. So I got a question. What's the difference between a 401k and a Roth IRA? So 401k is money that you did not pay any taxes. So, which is, for me, that's the first money you should put in. You should put money into your 401k or a IRA. And an Roth IRA is money that you already pay taxes, that you want to invest into a retirement account, where the earnings, like your earnings in retirement, is not going to be taxed. So that's where you want to put that's where you want to put like after tax money into a Roth IRA. All right, so I don't think we have any more questions. I think that's pretty much it. So thank you guys for showing up. This is going to be posted on the group. and we'll definitely see you guys next week. So I'm gonna be, just so you guys know, I'm gonna be posting I guess what do you call it? What do you polls, and to see what you guys want me to kind of go over the next live webinar. So thank you very much, guys, for showing up, and we'll see you guys next week. Have a good one, guys. Bye.